Okay, let's talk about the startup success myth. We're always told there's this golden ticket, this specific playbook for building a billion-dollar company. But what if the number one rule in that playbook is, well, just plain wrong?
I mean, you've heard this 1,000 times, right? The story is always the same. Brilliant founder, world-changing idea, they pitch a venture capitalist, get a huge check, and bam, a unicorn is born. The media basically tells us that venture capital isn't just an option, it's the only real path to a massive success story. But what if that whole story is just that? A story. So some researchers over at MIT decided to look past the headlines and actually dig into the data. They analyzed millions of businesses to see if this common belief, that VC funding is the secret sauce, actually holds up. And what they found is pretty stunning. Turns out the conventional wisdom isn't just a little bit off, it's almost completely backward. And the whole truth behind what makes a startup successful really hinges on this one single number. That's right, 4 out of 5, the huge majority of companies that actually make it big, we're talking going public with an IPO or getting bought by a bigger company, they do it all without ever taking a dime of venture capital. So those stories we hear all the time, yeah, they're the exception, not the rule. So this just flips the whole question on its head, doesn't it? If VC money isn't the magic ingredient, then what is? What's the thing that separates the big winners from everybody else right from the very start? Turns out the answer is kind of hidden in plain sight. The study found that all successful startups, whether they're backed by VCs or not, they share this kind of secret DNA. They follow what the researchers call a growth playbook right from day one. And we're not talking about vague ideas here. These are specific, observable choices a founder makes that act like huge, blinking signs of a company's ambition and potential. And these signals are incredibly concrete. It's not just about having a good idea. It's about how you execute from the get-go. For instance, incorporating in Delaware, that shows you're already thinking seriously about legal and financial stuff. Filing for a patent or trademark, that proves you have a valuable asset you know you need to protect. Even just choosing a short, catchy name shows you're already thinking about marketing and customers. And get this, these signals aren't just subtle hints. They have a massive, massive impact. To put it in perspective, the study found that a company that incorporates in Delaware and applies for a patent in its first year is over 120 times more likely to get VC funding than a company that does neither of those things. They're basically screaming, hey, I'm built for growth. And this is where it gets really interesting. It illustrates this subtle but super important difference. While both the bootstrapped successes and the VC-backed companies follow the playbook, they're speaking slightly different dialects of growth. The VC-track firms, they focus on signals for investors, like patents. But the bootstraps companies, they prioritize trademarks, a signal for customers, because, well, they need to make money from day one. Okay, so this brings us to what venture capital's real superpower is. It turns out it might not be about creating success at all, but something else entirely. So what is their actual role in this whole ecosystem? And here it is, the big takeaway. The primary superpower of venture capital isn't alchemy. They're not turning lead into gold. Their real skill is selection. They're like these incredibly sophisticated, data-driven talent scouts who've just gotten really, really good at recognizing those digital signatures of companies that are already on a path to massive growth. But wait a second, this raises a pretty critical question, right? If VCs are just following this playbook, are they really seeing unique, groundbreaking potential? Or are they just matching patterns? Are they just saluting the companies that already fit this neat little box of what they think a successful startup should look like? And the data really forces us to push this even further. I mean, let's be honest, the failure rate for VC-backed startups is insanely high. So if even their carefully selected, pattern-matched favorites fail way more often than they succeed, how much of a superpower is selection, really? And that leaves us with one last, really provocative thought to chew on. If the key to VC success is just a sophisticated form of pattern matching, basically checking off a list of early signals from this growth playbook, couldn't an algorithm be trained to do the exact same thing? Maybe even better? It's a question that could totally reshape the future of high-stakes finance and what we even think of as expertise.